Every day that a market melt-up continues, we're that much closer to the inevitable market meltdown that will take place at one point, perhaps in the near future. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and we get lots of questions from traders all over the world asking how can they hedge their long positions against market meltdowns using options. In this video, we're going to share with you an intriguing but very simple idea on how to anticipate a pullback in the market and hedge it cheaply and possibly for free with just a little bit of common sense. So if that sounds like something useful for you, then stick around. I think you're going to be surprised at how easy it is to implement this. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so this bull market that we've experienced off of the pandemic lows last year may be getting a little long in the tooth, and historically the worst month of the year for the market has been October. And it's not uncommon for markets to rally strongly earlier in the year and then give most, if not all, of those gains back in October, as happened in 2018 when the SPX index rallied from a low of 2553 at the beginning of the second quarter to a high of 2940 by the end of the third quarter, a gain of 15% for the whole market, and then gave almost all of that back by the end of October, dropping down to 2605 at one point in October of that same year. And so with the market rallying this hard for this long in 2021, it doesn't take much imagination to picture at least a pullback of some sort coming in the near future. And the market has often appointed October as the month for that exact occasion. And so traders start getting increasingly antsy about locking in their gains at this point in a rally, and what are known as index options afford traders a really unique opportunity to cash in on the inevitable sell-off that follows rallies of this magnitude. Now, to make sure everyone watching this video understands how index put options work, we're going to do a really quick review of that. And for those of you familiar with how they work, just hang in there. This is going to be really quick, and then we'll just jump right back into this strategy. All right, so the best way to understand an index put option is to think of them as bets that the market will go down. The put buyer pays the put seller a premium, which is like the wager that he's making for that bet. A put option on an index pays off $100 per point that the market closes below the strike price of that put option on the day that the put expires. So for example, if the market closes at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market did not close below the 4,000 strike price. It's as simple as that. Okay, so with that in mind, let's move back in time to August 16th, a few weeks back, and you'll see that the SPX index closed at what was at that time the all-time highs. And so suppose that a trader buys an SPX index put expiring in August right around where the SPX index closed at 44.80. Now that option will pay off $100 per point that the index closes below 44.80 on October 15th when the option expires. And that would be legitimate protection to pay on its own if you were concerned about protecting your long equity portfolio. But this trader had something else in mind, and that was the notion that the market is bound to pull back at some point during the next 2 months, at least briefly, and that will afford another opportunity to basically turn this into free protection for his equity portfolio. Now, before we get into exactly how this trader could effectively enter into a free hedge for his entire equity portfolio using a simple option strategy, if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, plus the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so let's move forward just a few days later, and as you can see, the market sold off back down to 4,400. Now, this is significant because it took place only a few days after the trade had opened up, and the October options are still very valuable as they're almost 2 months away, and the market is pricing those options with the risk that there could indeed be an October sell-off, and therefore the prices are quite high. And so if the trader were to, at that point, sell the 4360 put that expires on the same day as the 4480 put that we already own, then he would be entering into what options traders refer to as a put debit spread. Now, let's drill down into the cash flow of this trade so you'll understand the significance of what just happened. So as we just said, we received $103.87 for selling that 4360 put after the market sold off. But remember, that pays off $100 per point below that 4360 strike price. So you multiply that by $100 for a total cash inflow of $10,387. But remember, it cost us $100.37 to buy the 4480 put a few days earlier, which comes out to a payment of $10,037. So when you net the two down, you actually end up with positive net cash flow of $350. Now, the reason that that's so significant is that by taking advantage of that sell-off a few days later, the trader has effectively rendered this a free hedge for his portfolio. Now, how's he done that? Well, let's take a few different scenarios, and this will get very clear for you. So suppose the market were to sell off down to 43.90 in October. That would be a very mild sell-off of 90 points, just a little bit over 2%, so that's an entirely reasonable thing to imagine. Well, if that were to take place, then in that case, the 4480 put that we bought would have paid $100 per point for each point that the market closed below 4480. So that comes to 90 points, and so the put payoff would be a cash inflow into your account of $9,000. And the 4360 put that we sold, well, that one actually expired worthless because the index closed above its strike price. When you add back the original $350 in cash flow, then the hedge we bought would actually yield a profit of $93.50, which could go a long way towards modifying or even eliminating any damage that that mild sell-off did to your portfolio, depending on its size. But let's take another scenario now where the market just rallies and ends up at 4,500 on October 15th. Well, in that case, both the short and long options both expire worthless. So we're left with that original $350 of positive cash flow that we received. In other words, even if the market rallies and we never needed the hedge, the trade is still profitable because we were able to sell that 4360 put for greater than we had to pay for the 4480 put originally because we took advantage of that pullback that occurred right after we bought the original protection. And so the hedge ends up actually being a profit center on its own, even if it was never needed. Now, one point I'd like to make to you is that by selling that 4360 put as we did, we put a lid on the amount we could collect from that hedge. So for example, suppose that the index closed at 4,200 on October 15th. Well, in that case, then the 4480 put would pay off 280 points times $100 for a total of $28,000. But remember, we're short that 4360 put, so that would result in a payment by us of 160 times $100 or $16,000. So when we add in the 350 we received at the beginning portion of the trade, the result is a gain of $12,387. $350. And it can never actually get larger than that, because once we get to 4360, if you think about it, the amount by which the payout increases on the 4480 long put that we own is completely negated by the amount we pay out on the 4360 put, capping the value at $12,350 for the trade at any price below 4360. Still, you got to admit, that's pretty good. Once you get that initial sell-off and sell a put for a price better than we paid for the long initially, then the hedge is for free from that point on. Yet in the scenario you were worried about, the hedge can profit up to $12,350, which is pretty solid, where your worst case scenario is still a profit. And so what I'd like you to take away from today's video is that with a little bit of common sense and a good dose of options trading knowledge, you can structure a hedge that results in essentially a guarantee of at least some profit if you're able to just get a little lucky with your initial entry and get some kind of a reasonable sized pullback after you enter the trade. In any bull market, there are ample opportunities for pullbacks to be leveraged like this, and with some experience and options trading knowledge, you should be able to put yourself into this position fairly readily. Now, just to remind you, if you're serious about your trading, you need to check out our free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.